Good morning from London. I'm Kriti Gupta alongside Tom Mackenzie and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. U.S. Treasury Secretary Scott Bessent saying some countries without an agreement by the July 9th deadline may have the option of a 3-week extension. Meanwhile, President Trump said any country aligning themselves with, quote, the anti-American policies of BRICS would get an additional 10% levy. And China will impose some reciprocal curbs on medical device procurement for companies based in the EU, fueling further tensions between the two major trading partners, just as Beijing seeks to shore up ties with Brussels. And OPEC Plus agreed to a bigger than expected production increase next month, raising concerns around an oil glut, just as U.S. tariffs fan fears about the demand outlook. Valerie.
Checking in on these markets just an hour ahead of the opening trade. We do have S&P futures still in the red over the last two sessions from Thursday's close. So Eurostoxx 50 just hanging on to gains of 0.1%. Euro dollar below the 118 handle. And we've got Brent crude on the back foot after that surprise OPEC supply. The countdown to the opening trade starts right now.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
July 9th or August 1st? Donald Trump or Scott Bessent? Who do you listen to when it comes to these trade negotiations? Of course, we are still barreling towards that July 9th deadline. We are less than 72 hours away. But, Tom, we may get a little bit more, maybe, news in less than 12 hours' time.
Yeah, I think, to your point, we're getting mixed messages from the Trump administration in terms of where things land on this deadline. July the 9th, August the 1st, letters or no letters, frameworks or comprehensive deals. And the backdrop to this, strong markets. Treasury markets have stabilised, of course, equity markets near record highs, a little bit of softness in the session today. But is that, in fact, moving guardrails away from President Trump? That does allow him to go further and take action, for example, on BRICS nations? Because the equity markets and the bond markets are now behaving, and he doesn't have that concern in the rearview mirror, does that unleash him to go harder on these trade negotiations?
Yeah, at least for markets. You're not confused about the deadlines. We thought we were going to get these letters over the weekend, maybe even last Friday. Now Trump telling us they're not going to come until noon Eastern time today. That's 5 p.m. after London close. So again, it keeps feeling like this deadline keeps getting pushed out. You know, I did think that we were going to see markets higher this morning off the back of both Howard Lutnick and the Bessent comments about the August 1 tariff effective date, but it doesn't seem like the market took that too positively.
Didn't take it too positively. There's also a question here of the kind of the worst case scenario, because I think you guys outlined the positive side. Do we get sign of some incremental extension, some positivity? There's also the risk that it goes in the opposite direction, that you start to see that potential 70% that he had floated last week with the likes of Japan, for example. And I wonder how much of that starts to actually affect the nitty gritty of how a business operates when you're talking about looking at those levies that high.
And we know that sectors, of course, sectoral tariffs have been a key sticking point, particularly for nations like Japan, particularly for the European Union. Of course, we're focused as well on what's happening in terms of the dynamic between Brussels and Beijing. There had been a narrative that the Trump trade war would, in fact, push Europe closer to China and China closer to Europe. We're having reminders in recent days and weeks that that is not happening. And I should stress there are nuances around Beijing's actions. So the most recent line, of course, is they're making it difficult in terms of procurement for European companies based in Europe to be involved in procurement of medical devices in China, but not companies that are invested in China itself. So there's that nuance. If you're a Health Siemens or you are a Philips and you have invested in factories in China, you can still be part of that procurement process. And there's nuance as well around China's levies on branding cognac. If you set your pricing according to Beijing's specifics in China, then you avoid those duties. So yes, there is friction in this relationship. They haven't moved as close as some had expected. A summit between Europe's leaders and Chinese leaders in the next few weeks will not be 2 days. It will just be 1 day, according to Bloomberg. So it's a reminder that it's complicated. But equally, I think there's also evidence to suggest that Beijing is taking a fairly gradualist approach. They want to go tit for tat, but they don't want to go so far as to completely alienate the EU at this point.
Well, it's interesting that this is heating up at the same time. This tariff deadline between the EU and the U.S. is also happening. Maybe it's kind of a warning signal from China to the EU to say there shouldn't be any isolating of China in whatever deal that you sign with the U.S. You know, the similar things that we saw with Vietnam when there was a higher tariff rate when it came to trans shipments through Vietnam. You know, will we perhaps see a flavor of that in other trade deals that are signed with the U.S. later this week? China seems to be on the front foot, giving warnings that it should not happen.
It's fascinating as we know that China, of course, is also trying to circumvent some of those sanctions, trying to get to the United States regardless. But there is still this question, and we hear this with ministers all the time on Bloomberg programming, about whether or not the question of overcapacity in Europe is ultimately an issue. That inflationary concern around tariffs in the U.S. doesn't really apply to Europe, because you're talking about deflation as a function of that. And that's something that the oil market is trying to juggle as well.
Yeah, let's go to the weekend news about OPEC, a larger than expected supply increase. We thought we were going to get 411 barrels for the fourth month in a row. We actually got closer to 550, and some forward guidance that in their next meeting, they're also looking at a 550 increase. It goes to show, though, the oil market is taking this quite well. We have Brent crude down just 0.3% off the back of this. The group was citing in their decision that the steady economic outlook helped them boost supply, also saying that there's healthy market fundamentals and low inventory. So those are the reasonings behind the bigger than expected increase. But it seems like the market is absorbing that quite well this morning.
This is a win for President Trump, isn't it, Kriti? This is another win. He wants lower energy prices. He's getting them. Thank you, OPEC Plus.
He's getting them, but he's alienating his base in the process. And I think when you saw these kind of geopolitical spike as well that we saw with tensions around Iran, we've seen the Red Sea and the attacks as well, and the Houthis there. A lot of those shale producers that are part of his base actually hedged at those higher prices. So now you have a double whammy in terms of the long term, that not only are you getting more production from OPEC, not only are you dealing with the demand fears, but now you also have a lot of these shale producers who are going to be drilling to lock in those prices that they have been. And that's just kind of adding even more pressure on a market that's trying to stay above $50, $60 a barrel.
Well, it should be noted that this decision at OPEC lasted only 10 minutes, and it was unanimous. So it seems like there is a lot of, consensus behind adding these further barrels of oil to the market.
Absolutely. You saw some of the pricing out of Aramco as well. There's plenty to digest in the show today. Let's talk about who we've got coming up. Vincent Mortier, Amundi's CIO, is going to be joining us in just a few minutes. And then we get the take over at Goldman Sachs. Christian Muller-Glissman, the head of asset allocation over at head of asset allocation research, is going to join us right at those opening bells. Carol Maggio over at Barclays European Luxury Goods. The question about that relationship between Brussels and Beijing likely show up in the luxury space as well. And then how do you prepare from a company point of view for the tariff onslaught, regardless of the rate? Andrew George, Marsh Specialty President, is going to be joining the program.
And let's take a look at what's on the docket this week. There is not a lot of economic data this week, it has to be said, but we are staring down the barrel of that Trump tariff deadline coming on Wednesday. Before we get there, we do have the second day of the BRICS Summit in Brazil happening today. Tomorrow, the UK is going to host Macron in its first state visit. And then on Thursday, we do get a trickle of economic data, U.S. jobless claims ahead of Friday's employment data from Canada.
Yeah, it's going to be really interesting. We're seeing, to your point, not that much economic data, but does that change around Donald Trump's tariff deadline story? That seems to be the big one.
I think it just means there's more focus on every trade headline that comes out this week rather than anything economic that could possibly lead us. It's all going to be politics.
The consensus that we seem to get from analysts and our guests last week was brace for volatility this week. It's going to be volatile on the headline basis when it comes to these trade negotiations. You'll get deals, you get framework deals, you get a change to the time frames, and we've got an indication of that over the weekend. What's not clear is the impact on the data yet, and we still don't have that clarity, and you're hearing that again from central banks. We need to see the clarity. Maybe that comes through to the end of the summer. That's the steer we've been getting from Jay Powell and the Fed.
Yeah, that's right. And we don't have the next U.S. inflation report comes the week after, the 15th, so the middle of the month.
OK, here's what else to be thinking about this morning. Rescuers in Texas are still searching for at least 10 children and a camp counselor who are missing after catastrophic flash flooding. At least 70 people have died, including many children attending youth camps over the holiday weekend. Officials are struggling to explain whether they did enough to warn people of the fast-rising waters. It's feared the casualty count will climb, with more heavy rain forecast in the coming days. And BRICS leaders have condemned US and Israeli attacks on Iran and called on Prime Minister Benjamin Netanyahu's government to withdraw troops from Gaza. In a joint statement released on Sunday, the 10-member bloc of emerging market nations said the strikes on Iran constitute a violation of international law and the Charter of the United Nations. They also called for a permanent ceasefire in Gaza. The feud between Donald Trump and Elon Musk has intensified, with the US president criticising the Tesla CEO's plans to start a new political party. Musk announced on Saturday that he was forming the America Party a day after Donald Trump signed the tax and spending bill that he had denounced. The move is sparking concerns among investors that Musk's increased focus on politics could distract him from his role as CEO of Tesla, which has already seen its stock lose over 20% this year. So Elon Musk setting up a new political party. We don't know the details of this. We haven't seen any official filing yet. We don't know who's going to be part of this party. But it's a reminder that he's not walking back from his politics. It's not walking back from his clear focus on the big, beautiful bill. He is clearly, and he is consistently, to give Musk his credit, he has consistently been concerned about the size of spend around government and the deficit and the debt load. He's been consistent on that. And he's not walking back from his political intentions, but at the risk, of course, of putting Tesla under pressure.
Yeah, that's right. And I guess, what are Tesla shareholders going to be thinking about this? They clearly wanted him to step back from politics, and launching, another political party was probably not what they had in mind when they say step back from these ties with the U.S. president. We have seen the shares trade lower on TradeGate on very thin volumes, but it's looking like we're another 5% lower for Tesla so far this morning.
Well, we've seen this movie before in two different ways. When Elon Musk pursued the acquisition of Twitter, now X, we saw the Tesla actively, the entire market, because that Tesla weighting, actively respond to it because of what that would do from a weighting perspective. We also saw from a political standpoint the fact that Elon Musk wins elections. Sometimes it isn't ultimately a funding story. If he pulls his support from some of Trump's favored candidates in the midterms, for example, that are coming up, what does that do to the political landscape of the United States? It's certainly a fascinating one. We're going to be keeping a very, very close eye on. Let's talk about what's coming up on the program. European luxury brands have, on average, 20% exposure to U.S. markets. We're going to dive into how the trade war could impact their bottom line. Plus, global insurers still gauging the potential disruption to supply chains from those levies. Up next, though, right back to the market, Scott Bessent floating the possibility of an extension of trade deadlines. Is this a sign of relief from the financial markets? We're going to dive into those details. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
We're going to be very busy over the next 72 hours. President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2nd tariff level. So I think we're going to see a lot of deals very quickly.
U.S. Treasury Secretary Scott Bessent there speaking to CNN about what the timeline of those trade deals look like as we barrel ahead to that July 9th deadline. Valerie Tytel is with us, walking us through how the markets are thinking about it. Val.
Is August 1st the new deadline? We heard it there from Treasury Secretary Scott Bessent. We also heard it from Commerce Secretary Howard Lutnick that August 1 is the new effective date for this next round of tariff increases. It really goes to show whether the market is interpreting this as an extension or not. You can see here the lift to U.S. equity futures on the Asia Open. Yes, it was slightly positive, but really nothing compared to the hot payroll report and the record highs that we reached on Thursday. Also, take a look at how the Bloomberg Dollar Spot Index is reacting to this, because remember, the U.S. dollar has been trading strongly on days where we get good news about global trade. So in that, guys, hey, we are high. We're 0.2% higher on the Bloomberg Dollar Spot Index. So maybe some optimism baked in, but it seems limited for now. And perhaps we have a closer trade deadline than imagined. We did get a tweet out from President Donald Trump talking about these letters sent at 12 p.m. Eastern. That's around 5 p.m. London, Kriti, after the close here in London, but maybe a new risk event on the horizon for today.
Certainly one that we are all going to be watching very, very closely at the edge of our seats. We thank you so much, Valerie Tytel. Let's get a little bit more analysis here. Vincent Mortier, the group CIO over at Amundi, joins us this morning from Paris. Vincent, a pleasure to have you on this program. Look, Valerie was talking there about how we are getting closer and closer to this trade deadline. Whether it's July 9th or whether it's August 1st is up for debate. But there is a question here about whether the expected volatility is actually manifesting. Is there a complacency to this market?
Well, for sure. I mean, normally tariffs should, all this circus, I would say, or noise around tariffs should bring uncertainty, should hit the consumer sentiment, should hit inflation, maybe profit margins. At the end of the day, it's fair to say that markets are just going to the next phase. anticipating that the impact won't be that high, and that finally US will probably win this game, which is, I mean, it's a little bit complacent, as you said. Volatility has come back to super low levels. US markets are all-time high, so I mean, it may happen, but we have not yet seen really the impact of these tariffs, which, just as a reminder, will eventually be at a level never seen in the last century. So it's meaningful. It's not just a short-lived event, but indeed, markets have been pretty complacent so far.
Well, Vincent, what matters more to these markets, these trade negotiations or whatever dribbles we get of them, or perhaps the questions around the U.S. deficit? When it comes to that exposure to the United States from an international perspective, what matters more?
You're right to mention. For me, what is more important is a big, beautiful bill, which can have very significant impact on U.S. deficits, the amount of debt to be issued, and it could have a more long-lasting effect than tariffs, because at the end of the day, tariffs, the effect will be spread. The cost will be borne by many different players. Here, the sustainability of the US debt trajectory will start to be questioned. And you mentioned just before the course of the US dollar. When you have such big twin deficits, normally the US dollar should continue to weaken. And as well, given the metrics you are talking about, 6-7% deficit for many years, which is quite outsized, we think more and more investors will try to hedge or to diversify away slowly but surely from the US dollar. So that's why we are on a long-term basis quite bearish on US dollar.
So still long-term basis. Good morning, Vincent. Still long-term bearish on the US dollar, despite the softness that we've seen, 6 or 7% so far year to date, downside for the greenback. Vincent, what about the case to be made that the tax cuts, they're a fiscal stimulus for US equities, particularly maybe some of the smaller mid-sized companies? You get a clearing event maybe in terms of trade deals by August the 1st, and you have further upside for US equities in an environment and in a US economy that is showing no signs of recession, at least for now. How much exposure do you want to US equities at this point?
Well, in fact, you know, the tax cuts are essentially the continuation of existing schemes and tax cuts which were expiring. So it's not really new stimuluses or new money put into the economy. It's just to avoid stopping some previous tax cuts, which would have been very, very negative to the US economy. So the matter of fact is that US economy is living beyond its means. So we know that it's very difficult to unplug. So now what is key for us for the next phase is what will be the level of margins and return on equity in order to justify paying 5 times price to book, for example, or 22, 23 times earnings for the next 12 months. And will US economy will be able to continue to be exceptional in terms of growth? And these are big question marks, because the only way to justify paying 22, 23 times earnings, which is much higher than any other equity market, is if you believe that earning growth will continue to be double-digit and even more 15 than 10, and that US economy will resume growing at 4 to 5% per year, which I mean, it's not that obvious given what is happening everywhere in the world, the slowdown we can see in many places, and the policy mix in the US. So the jury is still out. Q2 earnings, which will be released in the coming weeks, will be key as well to see the trend. But so far, when you are at all-time highs, some cautiousness might be warranted.
Okay, so the caution is there. Is the caution there for Europe as well, Vincent, amid this infrastructure and defence spend? What were your favoured investment around that, in terms of how you play that investment story, how you get exposure to that? Even if that's a 2026 story, how do you want to adjust the portfolio to get the upside?
Yeah, to be fair, it's more a 27, 28 story. It will take many time to unfold. and to have some meaningful impacts on the euro economy, in particular onto Germany. So it's not a short-term story, but markets are anticipating long-term trends. So far, what you have seen is many investors going the easy route, so meaning buying DAX index, so German equities, buying defense sector. Now we think it's a bit overdone, so it's better to diversify, to buy most of the stocks 600 index, for example, which is much more diversified, or to buy small and mid cap in Europe, which is quite cheap. So overall, you still have many ways to play Europe, but maybe not go the easy route, which has been the one used by investors so far. And it's time to broaden the exposure to Europe. And we believe there are still good news coming out of Europe, so it's not too late to be exposed, but probably just don't go where everybody has already gone.
Vincent, you talked there about diversification. Given you have this long-term bearish view on the U.S. dollar, how are you viewing emerging markets here?
Well, emerging markets, it's whether it is India, even China, Latin America, are growing faster than on average the developed markets, and the differential for growth is maintained or even increasing. So you have growth, economic growth, you've got earning growth, and valuation levels are still quite attractive. So in a context where US dollar is also weakening, we believe that it's a very good opportunity to reinforce exposures to emerging markets at large. We don't believe it's too late at all. Each and every market has its own merits, but overall, if you want to find a growth and quite orthodoxy in terms of policy making, now you need to look at emerging markets, which is quite a new thing, because emerging markets used to be not really orthodox. Now they're orthodox, and the non-orthodox countries are to be found in developed countries, actually.
Vincent, when you're talking about emerging markets, are you more focused maybe on South American, Latin American economies, or Central and Eastern Europe? Which one do you think has more upsides?
Central Eastern Europe is very, very cheap, and it will benefit from any kind of resolution of the Ukraine war. Of course, we don't know when and how it will be done, but it will come one day, and investors are not positioned for it. So we really like Central and Eastern Europe. It is a little bit overlooked today. We like as well India. It is not cheap, but India is growing fast. Earnings as well, and we see many good things happening on the ground. And China as well, and China has been unloved or forgotten, but China economy is quite resilient, more domestic focus. So overall, to have some China exposures into portfolio is a must. And Latin America is a good diversifier. So overall, more than ever, we believe emerging markets should be part of the mix for a medium long-term investor.
Okay, Vincent Mortier, Amundi CIO, thank you very much indeed. With views there on EM and pretty bullish as well on Europe. Broadening your exposure to Europe should be something you should be thinking about. And on EM, reinforce your exposure to emerging markets. That on a day, of course, when we've seen President Trump threaten 10% tariffs on countries that align themselves with the BRICS nations.
Yeah, it's a fascinating one as well, because it feels like we've heard so much of this tariff threats with Asia, with pieces of Europe as well, the UK, Switzerland. But notably absent is Mexico, Colombia, some of the early people who were facing those tariff threats. Maybe this changes that. Yeah,
maybe it changes the Indian discussion as well. We know that India was setting up retaliation, one of the other economies other than the EU that had forced retaliation on the table. Maybe this latest BRICS threat does pose some problems for those India trade negotiations.
And we'll see if it materializes, of course. Coming up, President Trump threatens fresh tariffs, as we mentioned, on those BRIC nations. We'll get more details on that story. This is Bloomberg.
30 minutes away from the start of the opening trades across Europe, futures are a little quiet, a little complacent. Look, it's the summer, so you're going to see a little bit of quiet trading to the point that you're literally unchanged when it comes to Eurostoxx 50 futures, but perhaps some underperformance on the FTSE 100. I don't want to exaggerate it, though. It's only down about 0.2%, but we're certainly going to keep an eye on it, as, of course, over in the States. U.S. futures selling off by over 0.5%. Let's talk a little bit about the bond market as well, because perhaps you are seeing maybe a little more movement there.
Yeah, not that exciting, Kriti, I have to say. European government bonds were rallying quite, just under 1 basis point on the German 10-year yield. Maybe following treasuries this morning. Treasury yields are lower by 2 basis points.
OK, and a lot of the moves, of course, tied to what is happening on the trade front, and there is uncertainty in terms of how that all unfolds in the days ahead. Nations, of course, scrambling to secure trade agreements with Washington or lobby for extra time ahead of that Wednesday deadline. President Trump will be sending out tariff letters to trading partners, at least some of them, later today, he has said. Joining us now is Brendan Murray, who leads Bloomberg's global trade coverage. Brendan, should we think then of August the 1st as the new deadline? They've been very clear. August the 1st is when tariffs come into place. But is it clear that that is a window of opportunity for some of these trading partners to negotiate beyond July the 9th?
That's the message that we got from Secretary Bessent, the Treasury Secretary, on the Sunday shows yesterday. He was asked, is that the new deadline? He said, well, I wouldn't think of it as a new deadline. But if you look at what they've said all along, they've said July 9th is the date that you're going to get your new tariff if you don't negotiate with us. July 9th is 2 days away. These letters are going to go out, and they're going to get, as Bessent said, another 3 weeks, basically, to bring a deal to the table. So it's kind of like the debt collector who says, this is the final time. I'm going to warn you that you have to come to the table and pay up. This is what it sounds like from the Trump administration, that the countries that aren't really negotiating literally have 3 weeks to do so, or they're going to get hit.
Brendan, talk to us a little bit about the carve-outs here, or potential carve-outs that may be coming. If we talk about getting to some of these trade negotiations, there is a question in the markets of perhaps these big, scary 50, 60, 70% numbers not being as bad because of the carve-outs. How realistic is that?
I think some of these countries, Japan, South Korea, the European Union, are really lobbying hard to get lower rates on these sectoral tariffs. These are the tariffs that were announced outside of April 2nd, Liberation Day, and those are really going to hit those auto exporters, those steel exporters really hard. And if they can't get some clarity about what those are going to be, if they can set up some sort of quota system that limits the damage to their domestic industries, then they can find some relief in those. They're also trying to figure out what their reciprocal rate is going to be. It's going to be at least 10%. Everybody's getting at least 10. So they're going to try to minimize that as best they can.
And we just heard, just a few hours ago that Trump is now threatening an additional 10% levy on those nations that ally with BRICS. Do you think that could imperil some trade negotiations, especially India, which we've heard has, made some progress? Yeah,
exactly. So, yeah, a lot of those countries are in doing these parallel negotiations with the administration right now. So it definitely, this is an issue that Trump has complained about a long time. The BRICS are aligning themselves to come up with alternatives to the dollar, to things that would really upset America's hold on the global order, and Trump, who doesn't seem like someone who likes to be left out of a party, is saying if you continue to align yourself against our interests, then tariffs are the way I'm going to hit you with. China's already facing 30-55% tariffs, depending on the way you calculate it. So another 10 on China is, it's not going to make that big of a difference. But certainly, I think the president is saying, if you start aligning yourselves as a group against me, other countries could do the same. Canada, Europe could get together and form some kind of wall against what Trump is doing with tariffs. He's trying to head off that group mindset that could pose a significant geoeconomic balance against what he's trying to do with the U.S.
Brendan, there is no group mindset between Europe and China at the moment, it seems. So we're going to be watching the likes of Siemens Healthineers, Philips today on the news that China is making it more difficult in terms of procurement for those companies if they're based in Europe and looking to be involved in the procurement process in China. What do you think is happening? I mean, how much friction is there between Brussels and Beijing at this point?
It's been growing steadily over the past few months. They're kind of taking shots at each other. There's not a full trade war going on there, but there's this summit in a couple of weeks where this was supposed to be the culmination of the Europeans and the Chinese figuring out a way to get along, play by global trading rules, the way Donald Trump is not playing by global trading rules. But that event, this summit, is looking like it's going to be a bit of a bust if they can't pull it together in the next couple of weeks.
All right. Bloomberg's Brendan Murray walking us through the various trade dynamics that are really reshifting around the world. We thank you so much. It's something that's actively affecting the oil markets as well. Oil's on the back foot this morning after OPEC Plus agreed to boost production by more than 500,000 barrels per day in August. The bigger than expected hike surprised markets and raised concerns of a supply glut. It all comes as U.S. tariffs spark worries about the demand outlook. Bloomberg's Horizons anchor Jumana Bercecci flew in just to explain how it's all going. Walk us through. I want to go through the demand story in a moment, but start with the supply first. What is OPEC Plus thinking here?
Yeah, well, I think they are thinking that the market can readily absorb these extra barrels that they keep bringing back to the market. They surprised to the upside once again on Saturday. And by the way, I should also just say that this was a 10-minute meeting. So it was very quickly wrapped up. It was unanimous. The G8, the so-called the Group of 8 voluntary cutters, decided to put back 548,000 barrels per day back to the market as of August. They've insinuated they could do another sizable increase as well at their upcoming August meeting, which would mean that by September, they would have fully put back the 2.2 million barrels per day voluntary cuts that they introduced 2 years ago. And that is 1 year sooner than what the market had anticipated. And yet, you look at what oil markets are doing today, and Brent is still trading at around $68. So why? The justification, they say, is that the global economic outlook is still pretty steady. There are still healthy market fundamentals, including low inventories. Now, of course, that is what they're saying right now. We are in a period of very high seasonal demand, so the seasonals have been favorable. We've got to see how this all pans out by the end of the summer, which is probably why they're using this window now to put that extra barrel back to the market. But then also, very clearly looking to regain market share. These are OPEC producers, some of the biggest producers in the world, like of Saudi Arabia, UAE, who are sitting on millions of spare capacity and have not been able to put those barrels to the market. They're now looking to regain some of that market share in an environment where non-OPEC producers keep building up their own supply. And then finally, and this is not something that they would say explicitly, but there's one person, and that is the man in the White House, who probably wouldn't be too upset to see oil prices hold in where they are right now. He's, made no hesitation to claim that he wants to see lower oil prices as President Donald Trump, obviously. And the fact that we're sitting around $68 suggests that it is kind of a sweet spot for both OPEC Plus to put extra barrels back to the market and for the man in the White House himself.
Okay, so maybe a nod to keep the man in the White House happy. But what is the oil market going to be looking at over the summer to sense if there is any oversupply?
So here's the thing. I did mention the seasonal demands, and typically over this summer you get peak refining periods. So this is when the refining activities is at its most active. And by the end of the summer, that starts to die down. You also get a lot of electricity demand, Gulf countries, obviously air conditioning, transport fuel demand out of the U.S. as well. So by the end of the summer, some of those seasonals will start to die down. So from there onwards, you want to look out for what happens to inventories. And I thought it was really interesting that in this release on Saturday, OPEC Plus specifically mentioned the low inventories level. Once those stockpiles start to build up, that is a sign that you are beginning to look at an oversupplied market. What does that do? That starts to put downward pressure. And so there are analysts out there, the likes of Goldman Sachs, JP Morgan, saying that actually in the coming months, what you're going to see is supply growth grow 4 times the speed of demand growth, which means that you will start to see more downward pressure. They have a forecast of low $60 for Brent by the end of this year. So you want to watch out for that, in addition to non-OPEC plus supply growth as well, which continues to grow.
And Jumana, you talked about the market share story. Is this targeting, who are the Saudis thinking? Are they thinking about the US? Are they thinking about Canada? Who are they thinking about when it comes to taking market share? What does it mean for Saudi Arabia as well in the weeks and months?
Yeah, I mean, it's a really valid point, right? Because the US is basically self-sufficient now. They're the highest oil producers in the world. And so for Saudi Arabia, their biggest buyers come from Asia. And it was really interesting over the weekends that Aramco put out their OSPs, their official selling prices. They've actually raised prices all around the world. So all of their customers now are looking at higher prices to buy the Arabian crude. And that, I think, is a reflection of how they see demand. And I spoke to Amin Nasser a couple of weeks ago, the CEO of Aramco, and he was pretty positive on demand, specifically demand coming out of Asia, which is contrary to what most analysts would say. But the fact that they're able to raise their prices, which probably will hit some of the refiners in Asia in the coming months, suggests that they're confident that those buyers are still going to be there and they're still going to show up. And therefore, there are willing buyers for the oil that they want to put back to the market. One other thing that Amin Nasser said to me when I spoke to him was they're sitting on about 3 million barrels a day of extra capacity in Saudi Arabia. He says that every 1 million barrel per day is sort of akin to about a $10 price decrease. So that's your cushion. It gives them the cushion. So they are selling more at lower prices. For them, actually, the economics still kind of make sense.
OK, Jemima Pescetti, breaking down what we've been hearing from OPEC+, that decision, of course, that surprised the markets, the implications as well for the buyers in Asia, China predominantly, and, of course, the Saudis looking to build out that market share. Jemima Pescetti, our Middle East correspondent, thank you. Coming up, France's Capgemini is planning to acquire IT outsourcing firm WNS for $3.3 billion. More on that deal and other stocks we are watching. That is next. This is Bloomberg. Welcome back. We're about 15 minutes away from the opening trade. European futures a little softer, pointing down by 0.1%. You had losses through last week, of course, across European stocks. US markets, of course, reopening later today after that national holiday on Friday, pointing low on the S&P E-minis by around 0.5%. Let's go to Kriti right now for what's caught Kriti Gupta's eye this morning. Kriti.
Well, Tom, I feel like with these trade deadlines that are approaching, whether it's July 9th, whether it's August 1st, there remains this question in the air of what U.S. exceptionalism, or should I say that right, actually means. Now, Michael Masico, one of our colleagues who will be joining us later in the program, had actually put out a story out this morning talking about some charts that really show it. This is the one that caught my eye specifically from him, which is really just doing a very simple chart where the S&P 500 trades at in terms of the PE ratio relative to the MSCI World Index, taking out the United States. I think you can tell which is which here. Of course, that massive premium commanded by the United States, it is that white line hitting about 45 times times earnings. And that's going to be really, really crucial here, because one of the other questions, Tom, that we're asking quite a bit is whether or not that dollar weakness almost incentivizes hopping into the U.S. markets. And that's a really key piece, because that dollar weakness perhaps takes away just a little bit how expensive it is for international investors to get exposure given this kind of valuation. I think that's the key piece, Tom, when we're talking about especially going into the trade negotiations, talking about deficit deadlines, whether it's the end of August, early September as well. Do you still want exposure to a country that is still growing fairly fast, but maybe dealing with inflationary pressures, maybe dealing with these valuation questions that's showing up in the currency market, it has yet to do in the stock market? Maybe this comes down a little bit more.
Yeah, Vincent Mortier, of course, of Amundi, CIO, telling us earlier he doesn't think so, and he thinks there's further weakness as well to come through for the US dollar. He favours emerging markets and Europe at this point over the US. Joining us now for another view is Markets Live Executive Editor Mark Cudmore. Mark, you are full bull this week, despite all the tariff risk.
Yeah, absolutely. Good morning, Tom. I think in this short term, I don't know why you'd be proactively bearish this week compared to your stance 2 weeks ago. Now, the backdrop picture is I still believe that US stocks continue to underperform as they have this year. But I think that, and that's because the rest of the world can outperform rather than being overtly bearish. But I think there will be times to be nervous about US stock markets given how expensive they are. But right now, the most recent developments are massive fiscal tailwind. We've had the big, beautiful bill passed in the US. We've obviously had NATO defense spending. We've had some really good macro data. And the tariff deadline has been quasi-delayed to some extent. I know there's some uncertainty. But at least compared to a week ago where we didn't have the bill passed, we didn't have that really good jobs data, ISM data out before the weekend, we didn't know what was going to happen on tariffs. Everything has turned marginally positive. Now, I understand, given the valuations, why people might want to sell into rallies to trim long exposure, but this does not seem like the kind of market where people are going to chase dips and try to get aggressively bearish. And so I think that we'll probably see US stocks, despite the fact they're trading weaker at the moment, I suspect we'll probably see them higher later on this week.
All right, Mark, so you're bullish on the equity market, but how does the U.S. dollar perform on this perhaps extension of the trade deadline to August 1st?
I've no real conviction on the short-term view. I think, unfortunately, it's the same story I've kind of said all year. Longer term, I expect the dollar to continue depreciating much further. In the short term, the dynamic is that the market has shifted from being the short-term market shifted from being very long dollars to being a little bit short dollars, and the pace that move makes people worried. But the fact is that structurally the world is very overexposed to the dollar. This week, I have no particularly strong view of the dollar. If you made me pick a decision, maybe a little bit of a dollar bounce because of the squeezing of the BRICS nations on the latest threats over the weekend, but no particular conviction on that short-term view.
In the long term, though, Mark, let's talk about, or maybe not long term, maybe 6 months in TV, that is the long term. Talk to us a little bit about what matters more, trade negotiations or the deficit deadline?
I think trade is absolutely the biggest picture. It's going to kind of feed through over the next coming years. I don't think all the impact happens now. Let's just say that a month or two from now, we have all these tariff levels set. And there's no more talk about tariff deadlines and no more changes. It's still going to take years to feed through because what happens is after 80 years of US being absolutely in a special position as favored nation for doing business, you wanted to be in US supply chains, you wanted to get access to US markets. The world is suddenly going to go, it's not worth it. It's not worth it for the policy uncertainty. So as you get choices to change your supply chains or update over the coming years, you're going to turn away from the US. So the cost for US businesses is going to slowly increase over time. And that's even after the tariff deadlines. So trade is by far the biggest story for the next coming years.
Perhaps we'll get some direction on that in just less than 72 hours' time. Bloomberg Markets Live executive editor Mark Cudmore joining us this morning. You can get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're watching Capgemini over in Paris today as the company announces a $3 billion deal to buy WNS over in the US. Now, this is a company that specializes in AI, so potentially we might see a bit of a boost, bit of positivity on Capgem. Now, that stock has come down a bit from the highs of last year, but the analysts still remain really positive on this stock. Not a single sell rating on Capgemini. We can see that on the screen there. 0 sells, 17 buys on the stock. Potentially, we're going to see them maybe disappointed slightly on the price, but potentially, if the AI theme plays in well, potentially positive on that one. Then over in Italy, we've got Generali news at the weekend that UniCredit is selling down some of its stake in the insurer. We can see Generali's own stocks actually come off a little bit as well recently, underperforming UniCredit. However, we've also got an upgrade for Generali today over at JP Morgan, which reckons there could be some decent capital returns coming for Generali. So two bits of news there kind of countering each other. We'll see how that opens up over in Milan today. Then we've got Shell here in London, a little bit weak on their trading updates, kind of a production update more than revenue, and sales does look a little bit soft given the decline that we've seen in oil prices. We can see Shell stock absolutely falling off a cliff in the around March-April period. It has come up a little bit today, but this does look a little bit weak. And obviously, we've had the speculation around a BP tie-up. They've kind of brushed that off, but we could potentially see Shell a little bit weaker here in London trading this morning.
All right, Joe Easton from our equities team, we thank you so much walking us through some of the stocks that may move at the open. We are about 8 minutes away from that. We'll see how much of that shakes the broader markets as well. But there is still this idea that the major stories driving this week, at least, it's not monetary policy, it's not deficit, it's not geopolitics. It comes back down to those trade negotiations. And yet, these markets feel kind of sleepy.
The headline, volatility, could be something that wakes them up in the days ahead. Mark Cudmore is bullish on equities in and through this week because he thinks ultimately on the data front, on the tariff story and on fiscal stimulus, that is all going to prove supportive for these equity markets. Is the top line that this is a president who wants the sweet spot of strong equity markets, a relatively relaxed treasury market, and he will settle for deals, even if they're framework deals, that allow him to come out and say we've made progress, but also can talk up the fact that these equity markets are at record highs.
Yeah, and look, to Mark Cudmore's point, if you buy the fact that the August 1st date is now the new deadline, maybe you can almost ignore what's in these letters, because there's 3 more weeks of negotiation to be had before they go into effect. I mean, maybe that's quite a risky stance to take, given that we could see some shock stock in these letters. You know, Trump did mention last week a 70% number included in one of these letters, which is way higher than anything the market expects. But if you take the view that anything in these letters doesn't matter because there's 3 more weeks of negotiation, there's an argument to buy the dip here.
An argument to buy the dip, an argument to buy the dip from where? Who is buying the dip? And I think that's a really fascinating conversation. Guy's not here today. He's off, but I'm going to channel him because he keeps talking about this currency impact and where that actually shows up. There's a big question here about whether at the end of the day, the dollar weakness incentivizes the bid into the stock market or does the opposite if you start to see them trade in tandem.
I love that you're channeling your inner Guy.
And I can't help it.
Brings us up to the FX space. I want to see more channeling of Guy Johnson via Kriti.
Because we don't get enough of Guy Johnson as it is.
But look, Mark was talking about how fiscal stimulus was going to be a tailwind for the U.S. equity market. There is some talk of fiscal stimulus in Japan around their elections, and it's giving a jitter to JGBs. Now, this is not kind of the price action we saw in treasuries after the one beautiful bill was passed, but it does seem like JGBs are focused on fiscal spend. We saw 30-year JGB yields up around 10 basis points around this. So fiscal spending is still worrying some out there in the bond market in Japan.
Broadly, when you take this a step back at the end of this year and you have all the issuance coming out of Germany, you have the issuance coming out of Japan, the issuance coming out of the US.
Held in pretty well.
What do the bond markets do? They continue to absorb all of this?
Well, you brought up the question of emerging markets as well, and you're starting to see the carry trade perhaps be a little bit juicier here. I read some analyst research over the weekend that talked about perhaps that in this idea where you don't see volatility in the FX space to the same extent, that perhaps the carry trade is popular despite the risks that come with it. Coming up, we're going to see how this all shakes up in the markets. Futures, they're pointing a little bit lower, but not by that much of a margin. Remember, it is a little bit of a quiet day. I say they were pointing lower. They've now bounced up just a little bit. We'll see if it sticks. Stick with us. This is Bloomberg. We are a few minutes away from the opening trade across Europe. Now, look, we did see the U.S. markets were closed on Friday due to Independence Day. On Thursday, it was a half close. So in terms of what the setup looks like into the European Open, this is the best I can do. This says 2 days, but don't get me wrong, this is a 3-day chart. You saw a massive jump going into that half day of trading on July 3rd. And then futures kind of petered out a little bit. The actual market has not priced in what the futures are showing just yet. I wonder what that kind of sets us up for when it comes to this European session, Val.
Look, when it comes to European futures, we are maybe slightly on a better footing, just up less than 0.1% on the Euro Stoxx 50 futures. FTSE 100 is underperforming this morning. That's due to the recent drop on oil prices due to that OPEC supply increase. DAX futures outperforming this morning, up 0.2%. Tom, what single stocks are on our radar this morning?
Well, Val, you talk about energy, and so we are focused, of course, on some of the oil majors. Shell in focus in terms of the moves that could come through on softer oil, with OPEC Plus, of course, putting close to 550,000 barrels per day onto the market. Additional come August. Capgemini, this is a deal. It's a European IT services firm, of course, based in France, buying a US company for $3.3 billion to boost its AI proposition. So deal making in the IT space with a focus, of course, on AI. Capgemini, $3.3 billion deal for WNS Holdings stateside. Medical devices, of course, medical device makers will be in focus. Think Siemens, Healthineers and Philips on the news that China is taking some reciprocal action targeting them in the Chinese market. Kriti.
It's a fascinating one as well. You talk about the medical device makers. You named a couple there. I'm curious to see how it shows up in the broader index, though, as well. If you're concerned about concerns between, or tensions, I'd say, between Beijing and Brussels, does show up in the likes of the CAC, for example, that luxury exposure to China. Well, here we go. We're going to find out. It is 8 o'clock. That does mean the European markets have opened across the continent and right here in the UK. Right out of the gates, the FTSE 100 kind of wobbling around. You're not seeing much kind of momentum in either direction. Flat at the moment. Still waiting for the others to be opening as well, though. There is a question here, and Stock 600 kind of following the same dynamic that the FTSE 100 is. There is a question here, what matters more, the trade agreements that we are seeing or this idea of tensions with China? Remember, the European markets have exposure to both sides of the world. We'll kind of see how that kind of read-through shows up this week as well. There's also a question here of light volume, light liquidity. It is, after all, a European summer. Does that show up in some of these market moves or lack thereof? I'm going to kind of hand it over to you, Val, because simply the most exciting thing on this board today is a 1/10 move to the upside from the French index.
Well, when we were looking at the sectors just here in the first minute of trade, we do see energy to the downside as expected after that OPEC supply increase. We also have healthcare to the downside, one of the worst performing sectors on the back of the China retaliation against the EU on medical device procurement. So that is showing up in the sector movement so far. In the top of the basket, we have real estate and consumer products and goods. Tom, what is it looking like on the individual movers?
Yeah, Capgemini, a company, of course, we mentioned on the back of that deal for WNS, 3.3 billion. Down 2%. They're going to be paying, it seems, a 28% premium for that US company, kind of build out their AI proposition. So Capgemini under pressure. But despite that, as you said, you're seeing gains in the cap, just 0.1% across that index. We know that Shell is under pressure as well on the oil price moves. Not a huge surprise there. The surprise, of course, was the output decision from OPEC Plus. Not a big surprise that Shell and other oil majors, to your point, Val, is a little softer in the session, down close to 2% right now.
Yeah, we do see Siemens Healthineers on that medical device retaliation from China. Also to the downside, the eighth worst performing stock on the stock 600, down 1.5%. So we'll keep an eye on how those medical stocks trade so far in the open, but it does seem like there is a weakness in healthcare.
OK, let's get more analysis across these markets right now. Bringing Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Christian, great to have you in the studio as ever. Good morning. Thank you for joining us bright and early on this Monday. What are you expecting in terms of volatility around the trade story and how markets may be positioning? Are you comfortable with where markets are as we lead up to July the 9th?
I think there's been a bit too much relaxation. It feels like markets have shifted towards a bit of a Goldilocks regime where I think the data has been remarkably resilient so far, the hard data at least, and there's been very little impact on inflation. And there's this expectation that there's a lot of offsetting factors. Oil prices is one of them. There's this expectation oil prices keep falling into the end of the year. That's our view as well. But then you also have the view that housing in the U.S. is very weak. So that's all going to offset the tariffs. But it also is based on the assumption that we know what the tariff baseline is now. But if uncertainty picks up on the tariffs and we start to see the first signs that in the hard data there's some negative impacts, I think the market might question that Goldilocks pricing that it currently has.
What is the Goldman Sachs view on when the tariff story starts to show up in a material way on earnings?
July. I think literally now, I think we will get in that earnings season starting July 15th, we will get companies potentially reporting first impacts, but more importantly, give guidance. And we'll learn if this is a relative value story where there's a few specific companies impacted, or if it's an S&P, if it's a beta story. And I think that's what we need to understand, because if you look at the implied correlation, like how the market prices volatility in the earnings season, is it micro or macro? The implied correlation that's priced is very low. So the market actually thinks it's going to be a micro story that's very specific companies, but it's not going to be a big macro factor. And if you start to see breadth in the impact in terms of guidance from tariffs, I think the market is not priced for that.
Yeah, Christian, on that, is there any specific sectors you're looking at specifically when it comes to how they're dealing with these tariffs around earnings season?
Well, you can imagine anything that's exposed to the tariffs and goods. I think retail is a very popular area to worry about. I think, obviously, companies that rely on the global supply chain, Apple is often mentioned. Mm-hmm. So anything you can hear from them kind of working in those tariffs that are increasingly clearer where they will come out at, or possibly a lower bound where they will come out at, they will have to give guidance, these companies.
Do you think we're going to get any hints on the tariff pass-through to inflation on next week's U.S. CPI report, or do you think that's still too early?
It is a bit too early. I think we might actually get more information in the earnings season. So our economists have an expectation of 70% pass-through to the consumer. So it actually is a very small pass-through to actual corporates. So if we do actually see a larger impact to the corporates, it might actually feed in this idea that inflation will not have as big of an impact.
Because they'll be taking the hit on their margins instead of passing it through to consumers. That makes sense.
Yeah.
What's the bigger hit, though? The hit on margins or suspension of buybacks, suspension of guidance? We're already seeing elements on both in certain American companies, at least. I feel like it has yet to hit Europe yet. But what's the bigger red flag?
I think to me the most important is margin and ROE. Like we've done a lot of work showing that US equity valuations are very, very high compared to their own history, compared to other markets because of profitability, because of margins, because of return on equity. And if the market has any reason to start to worry about that superior profitability, even if it's just for a few quarters, I think markets might have to kind of reprice a bit.
But talk to us a little bit about what that incentivizes here, because even if you do see margins kind of compression, for example, in the States, it is still, from what I understand, a larger number, a larger profitability, to your point, than its European or even, I would argue, Asian counterparts as well. Do you start to see a weakness in the dollar incentivize a bit into the U.S. equity market that, as you put it, is expensive?
Yeah, I mean, listen, I think the U.S. margins, they're like at 20, like the ROE is like 21%. In Europe, you're looking at like 12, 13. So I think you have a major advantage as of now. And I think everybody is, because of the benchmark, somewhat overweight U.S. assets, somewhat overweight U.S. equities. So you're accepting that type of overweight when you have that superior profitability, that runway in the next years, that the U.S. exceptionalism continues. But if you do actually start to see signs of U.S. exceptionalism being questioned, I think the capital flow dynamic out of the U.S. Might continue.
But how much of that is simply a narrative shift as opposed to the numbers actually supporting it? You talked about a gap between of almost double, or when you have 23% and 12%, even a pullback to say, I'm throwing a number out there, I don't have the math on this, but to say 15% on margins is still better than its European counterpart.
No, 100%. And there's two things worth mentioning. First of all, you're absolutely right, so far it's a narrative, but we'll learn about that in the next earnings season in the coming month. And the second thing is, so far actually, the shift out of the US has been very marginal. Like most of the movements we've seen have been the dollar. If you actually look at the performance of US equities relative to European equities, there is no major underperformance anymore. It's all currency. If you look at fund flows, there was an element of repatriation in Europe, but globally, we've actually seen continued inflows into US equities. So I would actually say that, yes, it's been a narrative, but it's not been in the flows. So if the narrative does show up more in the flows, I think there's still more potential for US equities to maybe have a few setbacks.
Christian, you're just talking there about how a lot of the outperformance of European stocks has been more FX related. To that, guys, are you doing currency hedging differently this year than previous years?
No, absolutely. That's the big discussion. I mean, the big discussion is how do you manage, as an asset allocator, this U.S. asset dominance? Because we know diversification is the only free lunch in finance, according to Markowitz. So when you have 65% of the MSCI world in the S&P or U.S. equities, 40% of the Bloomberg Global Ag in fixed income in the U.S., you need to rethink a bit how to manage that U.S. asset dominance. So what we've been discussing a lot with clients is FX hedging. So like FX hedging in fixed income is quite common, but in equities, people usually run very low FX hedges. So there's much more rethink about that, because you have like nearly 25 to 30% of your portfolio risk being driven by the currency right now. That's the highest we've seen in a decade. So FX hedging is one way, but you have to consider that it costs. No, like there's a carry cost, especially for European investors. So there's a lot of rethinking. Like first you do the FX hedging. Afterwards, you need to think about portfolio shifts, and a lot of that hasn't happened yet.
Do treasuries look attractive in this environment?
Well, it comes down a lot to what happens with the tariffs, with inflation and the Fed. I think what we've been saying is that now with the Fed potentially cutting a bit more and a bit earlier, lower terminal rate, you can see the fiscal concerns also with the big, beautiful bill now being passed or having been passed. The fiscal concerns are easing a bit. So you could say that treasuries are starting to find their footing a bit. But the problem is, of course, if the tariff impact on inflation comes back and the Fed needs to backpedal, at least temporarily, I think treasuries, unfortunately, are also a bit vulnerable. But we have a range-bound yield as a baseline.
Well, in terms of the range-bound yield, I'm assuming it's the 420 to 460 that we've seen in these markets. Does a compression of oil prices, which is largely expected by these markets, push yields even lower?
I think it will help. No doubt, we know the longer-dated break-even inflation tends to be linked to oil, so falling oil prices can help a bit in the back end. But I would say that it's not a huge relief that you can expect. No, I think the main driver for the bond market in the U.S. is the Fed. And I think if the Fed does shift in a more dovish way because the tariff impacts are smaller, coupled maybe with a new Fed chair next year that has a slightly different view about the fair level of rates, the neutral rate. I think these things are very, very important for bonds in the US. I think oil helps at the margin.
Christian, before we let you go, we had Vincent Mortier from Amundi on the show earlier. He said when it comes to Europe, he wants exposure, but he wants to broaden out beyond some of the names that have benefited from the infrastructure and spending stimulus story. So beyond defence. Do you agree with that? Is there a broadening out of the European markets that can be taken advantage of?
I think as of now, definitely still a very narrow story. I think what we've seen a lot of clients focus on is factors. Like factors allow you to invest in Europe in a much more broad way. So, for example, the low volatility factor has been a very big focus where Europe has a lot of sectors, a lot of companies that in international portfolios can help. Banks have been a big focus. Obviously, defense and fiscal infrastructure have been a big focus. But outside of that, you actually have a lot of headwinds. Don't forget the strong euro is a major headwind for earnings. So coming into this earnings season, we will start to learn what that strong euro will actually do to some of the companies. So one has to be a bit more domestic as well. And domestic means usually less liquidity and less market cap in Europe.
All right. Christian Muller-Glissman, head of asset allocation research over at Goldman Sachs, joining the program this morning, covering a little bit of everything. We thank you so much. Let's get a quick check on the core six, the heavyweights, of course, that do move this European benchmark. It's kind of a meh kind of day. Novo Nordisk is the exception, though, down about 1.8%. This is, I think, crucial when we talk about some of the healthcare stocks. Remember, we did see a massive boost on Friday as well. The idea that there may be, big emphasis on May, some sort of carve-out, some sort of exceptions when it comes to the pharmaceutical market in the U.S.-Swiss trade deal. So something very specific to the healthcare story there, but you can see perhaps retracing some of the gains you saw. The rest of the market, I think Ferrari is the most exciting move there, higher by about 0.2%. Maybe Joe Easton has a little bit more drama for us this morning. Joe.
So one place that'll bring you some drama, maybe not so meh today, is the medical tech space getting hit today. We are seeing weakness in Healthineers, Philips and Carl Zeiss MedTech today. This, of course, coming from the news over in China over the weekend that the country is going to exclude some European Union medical tech companies from their procurement. That's a kind of retaliation against what the EU has been doing in terms of trying to have a bit of a hit back on the trade war on that sector. So we are seeing significant weakness in that market. Probably one of the only real exciting parts of the market, as Kriti was mentioning, not too many big sector moves today. But Capgemini also a little bit weak. This coming from the news that they are doing a $3 billion deal in the US for WNS. Now, this is an AI company. They are paying quite a big premium, around a 30% premium on the long-term price on that one. So we are seeing some weakness. Potentially the price is too high, according to analysts and investors on Capgemini. So that one is weak. And another weak one today is Currys not selling enough TVs and dishwashers and that kind of thing, according to RBC. They are downgrading the stock today. This is on macro weakness, a general weakness in the UK economy feeding through into the consumer. So RBC cuts the stock, and that reacting pretty badly to that downgrade, down 6% for that one today. Then over in the insurance space, over in Italy, we have got news of UniCredit selling down some of their stake in the insurer Generali, but that stock actually gaining. We did get an upgrade on Generali today from JP Morgan, probably taking the sting out of that news from the weekend. So Generali actually managing to rise. We're at 1.3%. On that one today, then Shell not looking very happy either. Most of the stocks we're doing today are pretty negative. Shell coming down, we're down 2.5%. We have had the oil price weakening today as well, so that's potentially feeding through. But Shell had their trading update looking pretty soft, all a little bit predictable given the glum outlook for the oil markets. They have given some pretty downbeat numbers on their production, as we've got on the bottom of the screen. And then finally, Stellantis. This one has a very negative note out from Bank of America today, saying that it's going to be a very bad second half of the year for Stellantis. Well, that price has kind of let me down, hasn't it? Because I thought it was down a lot more than that. I'm sure Stellantis is actually down 3%. Well, I'll have to recheck my data on that one. Bank of America downgraded Stellantis. I'm guessing that's the US price there. The one in Italy, take my word for it, it's down 3% because Bank of America think they're going to have a tough second half due to electric vehicle competition, and the stock take my word for it, is down 3% in Italy this morning.
We can confirm, Joe. Don't worry. We believe you. Down about 2.8% as we speak on the Italian index. We thank you so much. Joe Easton from our equities team. Look, it's interesting that he's talking about some of the pieces that he mentioned. The medical equipment sector, the Shell story as well. A lot of this seems to be more of a macro-driven story than a fundamental kind of equity individual company story.
Yeah, we were worried that this week was all going to be driven by tariff headlines. It seems like for Monday, that's not true at the moment. We're still following the macro story.
And Christian Muller-Gleesman, to that story, making a really interesting point on the macro versus the micro in terms of how the tariff story shows up, and that the markets right now are betting this is a micro story. Individual companies will be impacted, but at the macro and beta level, that's not going to happen. Yeah. He questions whether or not the markets are misplaced on that front. Coming up, as Trump prepares then to send out tariff letters to trading partners, it's going to happen today, he says. Will European luxury brands pass on the cost to consumers? We will have more on that. This is Bloomberg. Good morning. Welcome back to the opening trade. Happy Monday. We are, of course, 19 minutes into today's session. Broadly flat across the stocks 600, waiting for the next catalyst, and that is likely, of course, to be some tariff volatility. We had some news over the weekend, of course, and some question marks over whether the deadline is July the 9th or August the 1st. That is the picture then across these markets. The next catalyst is there being watched for. The DAX is up 0.3%. Over in France, the CAC 40 is flat, and the FTSE 100 here in the UK just down 20 points so far. Kriti.
Speaking of that tariff deadline, how the markets are pricing it in, let's talk about when European sectors are most exposed. Luxury immediately comes to mind. Tariffs as high as 31% on Swiss-made goods, threatening to significantly raise prices for American consumers. This dramatic shift could force luxury powerhouses to choose between absorbing the cost themselves and alienating loyal customers. Monitoring this trend is Carol Maggio, Barclays head of European luxury goods research, joining us around the table this morning. Carol, a pleasure to have you on the program. Thank you for joining us and making time for us. There is this big question about how quickly the margin gets hit. If the richest rich of the world stop buying into the luxury goods, is that a real risk, or are we overthinking it?
I think it is a risk to some extent. You know, when you think about the tariff situation, there are, to me, quite two kind of impacts. The first one, which is the direct impact, which will be, I think, quite small on luxury, P&L, because there's some high gross margin. You only, I think, touch a part of the COGS in the US, so it's quite, I think, limited. And I think, of course, the second impact will be the indirect impact on luxury spending. So basically how the consumer confidence level is impacted by those tariff situations and the lack of, I think, visibility in the market. And that, to me, is the biggest risk out there for the sector. So the lack of clarity on consumer base could make them buy less, basically, goods going forward.
How much does the recent escalation between the EU and China, especially when it came to brandy last week, does that change any of your long-term thesis?
I feel like at this stage, not so much. It is still early stage, and we are seeing anyway some weaker demand for the Chinese consumer base for the past maybe now 1 or 2 years already. So we have to see how it evolves going forward. But the view that we are going to be seeing weakness in China for at least the rest of the year, and maybe some recovery in 26, and then going forward in 27, some return to growth. But right now, Chinese market is quite under pressure anyway. So we haven't seen much change on the back of this recent news flow.
So is that particularly around LVMH and brandy and cognac? Or is that a broader luxury story that it doesn't turn around in China until 2026?
I think it's a broader story. We are seeing Chinese consumer demand being quite weak across the board, being on a soft luxury, hard luxury, pretty much everywhere. There is some negative growth coming from the Chinese cohort. So yes, we are to expect some weaker trends for, again, maybe 6 months or more across the luxury space.
What happens after those 6 months? I mean, is there a question here of investing in luxury as a buffer or as a store of wealth? Has that been a question, especially when we talk about things like depreciations in wider assets like the dollar, the stock market, arguably Bitcoin, if you subscribe to that? Do you see any sort of change in terms of approach of investing in luxury as a long-term bet?
I don't think so. Again, when you speak to investors, they still feel like the sector has not been, disrupted on the long-term perspective. They still view luxury goods as a really interesting, investment category going forward. And when you also, look at the, let's say, consumer perspective, so the buyers of the luxury goods, they also still, like to buy the goods because it's a long-term purchase, and even more so for jewelry, which also, of course, viewed as a very long-term purchase you can keep for a long time and even pass on to your kids or, something like that. So I think the level of appetite is still there for the long term, but right now, there is clearly a pause about buying luxury goods for the investor perspective and the buyer-consumer perspective as well.
Is there any hints that any of these European luxury names are changing their production, changing their supply chains in order to adjust to this threat of tariffs?
I think it's quite limited. We have been seeing LVMH during the first Trump mandate open some facilities of production sites in the U.S. for their key brands like LV, so Louis Vuitton. They opened, I think, one manufacturing facility in Texas, so of course a few years ago, and they still, of course, have it today, which is quite useful, quite handy to today, have a weaker impact of this tariff risk. But we have not seen many other brands follow suit and do, similar new openings in the U.S. on that side. It's still quite limited.
Not all luxury clothing names, of course, are created equal. Which ones have more resilience? Coming back to the first question around margins.
I think, back to the point of margin, who is more resilient? I guess you have the more defensive names like your Hermes, who, of course, has higher margin, is more exposed to really high-end consumer base, which tend to, buy still more in times of macro downturn. So there is, I think, less, let's say, mass market exposure to these kind of names. Similarly, we also like a name like Richemont, which is, again, exposed to jewelry, which is a bit more these days resilient. There is a bit more appetite to buy the goods because of its long-term, purchase, I guess, view from the consumer perspective. So I'd maybe flag Hermes and Richemont a bit more these days versus the other names in the space.
Have you seen, I'm going to ask an offbeat question, speaking of LV's manufacturing and presence, have you seen the building in New York City with the the suitcases? It really brought to me, I think, a question here of where people are actually able to grow their consumer base. Is it still the popular New York, London, Paris, et cetera, or is it China, the Middle East? Are you even a Latin American consumer? Where's that growth coming from?
I think it's still about China for the foreseeable future. When you think about what is coming next as the next growth driver, the brands all still talk about China as the most important market. So the growth, I think, will come from there to start with. And then I think that yes, the US is also interesting. When you think about the, let's say, US second or third tier cities like a Denver, for instance, like Cincinnati, you also, I think, have some room to open more stores in this kind of location. So I think that yes, these kind of markets to me still have some really interesting room for growth. Then you may have in the, let's say, next decade countries like India who could become bigger, but I think it won't be happening in the very short term. So
Carol,
it's still about China and the US.
Is there a euro strength headwind to luxury?
There is, yes. Of course, in my space, if you have a strong USD or like other currencies, it's like much better because, of course, a lot of the revenue comes from the other currencies. So, yes, if the euro is strong, it is not great for my space. Definitely, there is a risk on that.
OK, Carol, great analysis. Thank you very much indeed. With the deep dive, of course, on the luxury space, Carol Madjo, Head of European Luxury Goods Research at Barclays.
In the meantime, as we were speaking of that currency story, we did see some lines crossing the Bloomberg terminal. This from the ECB Centeno, saying that seeing there's a risk of undershooting the 2% as the main risk. He's making some comments here in an interview with EconoStream, which I'm told is a financial news wire. He's also saying that the weak Eurozone economy could see the euro correct versus the dollar. Some interesting comments, though, of course, as we look at a euro dollar at a 117 handle, still just shy, say, of 118. A little weaker today. We'll see if that continues. Coming up on the program, how are companies preparing for a more protectionist world? The president of Marsh Specialty joins us next to discuss the supply chain story, the consumer story, and how a CEO should be thinking about that risk. Stick with us. This is Bloomberg.
Letters out on Monday having to do with the trade deals. Could be 12, maybe 15. Secretary of Commerce right here. And I guess, Howard, I would say it could be maybe as many as 15 or so. And they'll be going out on Monday, and some will go out on Tuesday and Wednesday, and and we've made deals also. So we're going to have a combination of letters, and some deals have been made.
President Trump speaking alongside U.S. Commerce Secretary Howard Lutnick in terms of what the future of those next trade deals may actually look like and where the tariff negotiations actually stand. A crucial 72 hours, as he and both Scott Bessent say. Our next guest says most companies are unaware of how convoluted their full supply chains are and where these could be affected by those sweeping U.S. tariffs. Andrew George is president of Marsh Specialty, a division of the world's largest insurance broker. And Andrew's brief also covers aviation, sustainability, construction, and energy, among other sectors. He joins us now around the table. Andrew, pleasure to have you on the program. Thank you for joining us. Just walk us through the supply chain story here. I thought post-COVID, those issues had gone away.
No. Well, this is a story we've been, or something we've been working on for a few years now. Let me give you an example. If you buy a good from China, what you might not realise is there may be 145 or more companies upstream from that. So when you think about, I buy that good and I may pay the tariff on that or the tax on that, what is quite complicated is that there may be many companies behind that in China or in other countries, and there's cross-border shift of those goods. So it's very complicated to figure out exactly what that supply chain is and therefore the impact. So many companies are saying we need to really get underneath and understand the impact of that so that we know the financial impact on us and our profitability, also our resilience.
So what's the secret sauce to that resilience?
So the secret sauce is really understanding where everything comes from and then having contingency. What we found is one of our clients said we've got a very diverse manufacturing base. We use lots of companies in lots of different areas. When they looked at it to the ultimate supplier, those ultimate suppliers were all from the same city. Now, from a tariff perspective, that may be an impact, but it could also be an impact from a extreme weather or conflict perspective. And so what companies are doing is saying we probably need a diversity countrywide, technology-wide, and we need to think about how can we be most resilient and expect the unexpected.
Andrew, I just want to reflect back on Kriti's first question and frame it slightly differently maybe, which is how much additional resilience has been built into global supply chains since COVID, and what is the gap right now?
There's been a lot of work, and we've also seen trade patterns have shifted. As people look for cost advantage, people look for resilience. There's no doubt there's more resilience. But really, companies are finding every day there's gaps that they didn't expect. We built a platform, an AI platform called Centrisk, that uses a lot of data from different streams to demonstrate those gaps. And it's quite shocking, the amount of gaps.
Where are the most obvious gaps right now?
Concentration of... There's still a concentration, ultimately, of supplier from a countrywide perspective.
There's an over-reliance on China, still.
If I look at the energy industry, if we were in the renewable energy industry, and you were building photovoltaic, over 90% of the components for those would come from China. If you were building onshore wind, 60 to 70% of those would come from China. And so whilst there will be ramping up and building of other manufacturing around the world, there is an over-reliance in certain sectors.
Andrew, just because you're such a big player in the insurance industry, are you seeing any uptick in companies looking for revenue protection or some sort of way to hedge their tariff exposure amid all this uncertainty? Yeah,
companies are really getting underneath, first and foremost, what's right for their business. How can they thrive? How can they appeal to their investors that they have a resilient business? Part of that is through the work they will do with us to understand their supply chain. Part of it also will be ensuring that when they insure their revenue or their assets, that they're insured for the right amount. And the fact is, if your cost of production is going up because you're buying from countries where it costs more or there are tariffs, then those products cost more and therefore they'll be insured for more.
Are you necessarily seeing any bigger action in certain industries, or is there some sector that's coming to you more often for this kind of advice and guidance?
Manufacturing sectors, but we're finding when the tariff discussion was first muted, there were some that would say, let's wait and see. we're seeing far fewer of those now because they see that actually they can drive advantage from understanding their business more. And their investors are demanding that from them. And so those that have cross-border trade, those that rely heavily on manufacturing are really looking at those supply chains and how can they either decouple them or simplify them and make their business more resilient.
Can we go a little bit more sector specific here? I'm curious about your take on energy. It feels like the energy story in the States is very different in terms of the way companies operate, the way they invest than the story you might have here in Europe. Talk to us about energy security and energy production and where the tariff story overlaps from that.
Sure. One thing that is clear is that energy demand is going to increase. With the electrification of transportation, the use of AI, data centres, the demand for energy is going to increase. Now, we see on the bill that's coming in the US, that will reduce the tax incentives for renewable energy in the US. So we're expecting a flurry of projects in the next year. Projects that were on the design block will now actually accelerate and probably be built within the next year, ahead of the deadlines set out in the bill. What we'll then see is with the tax relief going away, that makes those projects more expensive. As I mentioned earlier, many of the component parts for renewable projects are from China, and so if you layer onto that increased tariffs, it will make those projects even less likely to happen within the next decade. So what we're seeing is we've got two countries here, America seemingly backing a fossil-based natural gas way to meet demand, and China backing a more renewable-based demand. One of the things we've seen, if you look at 2023, the US, and these numbers are relatively similar, the US exported 10 times more fossil-based energy product than renewable. China exported 30 times more renewable-based export versus fossil fuel. So it seems that there's a divergent path for the next period at least. What I would say is energy systems generally are long-term investments, 10, 20, 30-year investments. So oftentimes don't just move within a period of one government. So it will be interesting to see how it plays, but I expect more projects in the next year in the US.
Andrew, are you seeing more broadly, beyond energy, are you seeing your clients coming to you saying we are going to be reshoring to the US as a result of Trump's tariffs and the incentives?
I think every company is going through their own way of looking at things. One of the things that a lot of boards are doing is pausing and thinking, OK, do we reshore? Or what if there are other tariffs that happen? Or what if there are other things that happen? So what we're seeing is a lot of strategy developing. And I don't think companies are doing a lot of research. I don't think many of them are rushing to make decisions. They want to see how some things play out.
Talk to us very quickly, largely, about how much of those investment plans are ultimately based on the fiscal spend. You talked to us a little bit about the One Big Beautiful Bill, but when you talk about the spending coming from Europe, Germany, Spain, Italy, the countries that are more willing to spend, how does that factor into the thinking you're having with your clients?
So we want to be there with our clients wherever they want to invest, and we want to help de-risk those investments. Capital is an important part of a project, but technology and demand, and there are other factors. So you might be able to afford to build something, but somebody's got to give you an offtake agreement. A classic example are hydrogen projects. A lot of people talk about hydrogen and how that can accelerate. The challenge is you can build a project, you might get the capital to raise it, but unless you can get an off-taker that will give you a commitment to buy that off-take for a period of time, you're probably not going to build it because you're not certain that there's going to be a market there. So it's a very complex set of equations and not one that necessarily happens overnight, but actually needs time to play out.
Andrew, thank you very much indeed. These developments, this complexity, this is good news for your segment of the insurance industry, isn't it?
We're a very resilient company, and we're there. We're there to help our clients.
Of course, you are. There's the pitch. OK, Andrew, great analysis. Really appreciate it. Andrew George, President of Marsh Specialty. Thank you. Now, Donald Trump has threatened, on the same topic, of course, an additional 10% levy on any country aligned with the BRICS group, calling their positions anti-American in a social media post. The latest BRICS Summit kicked off over the weekend in Rio de Janeiro, with the group's countries seeking to strengthen their ties amid the US trade war. Bloomberg Originals explores the bloc's rising economic and political clout and whether it can truly unite as a counterweight.
This is a story about how the world's most powerful, richest country is slowly losing its influence.
And it's evident here.
We can see across Brazil, thousands of Ford cars almost disappear.
Meanwhile, China's BYD is becoming increasingly common. It's evidence of the growing connection between Brazil and China, the B and the C of the BRICS Plus coalition. This is a group that hopes to rival the US-led G7.
Over time, more countries started expressing interest in joining BRICS. So now there are 10 countries.
10 countries equals economic power. Look at how the original BRICS have grown compared to the G7 in terms of global GDP since 2009. It surpassed the G7 in 2019. Now add in the expanded lineup, and its share is nearly 40%.
The trajectory is clear. BRICS countries are growing faster.
This mantra,
America first,
has created an opening.
The trade war increased the solidarity between BRICS nations.
They want a multipolar world in which there are multiple centers of geopolitical influence.
But can these countries unite to become a meaningful global force?
It's very effective as a symbolic grouping, but how that evolves is probably going to depend to some degree how all their individual economies do, how they perceive the US is moving economically and politically, and how seriously they themselves want to move on big global issues.
And subscribers can watch that documentary right now on the terminal and on Bloomberg.com, and of course on Bloomberg Originals YouTube channel tomorrow. And this, of course, all in light of President Trump's threat of 10% tariffs on BRICS nations, or at least countries affiliating themselves with BRICS nations, which I think is an important distinction, because is he going to be looking to target China, for example, after that framework agreement with an additional 10%? Is he looking at an additional 10% on India, which we know is getting closer, we hear, according to reporting, to a deal with the US? Or is this targeting the Saudi Arabias of the world, which have become a little closer to the BRICS? Is it a warning signal to them and de-dollarization movements around the yuan? So unpicking that, I think, is going to be important for these markets, but that was another headwind.
At least it seems like they're trying to alienate China further. I mean, you can read that through this, that anyone that agrees with China on this BRICS communique, you know, he is not in agreement with on the back foot. But if you look at markets and how they've kind of digested this recent threat of 10% tariff, you are seeing a reaction in the South African rand. It's weakening over 1% this morning versus the dollar. Also, dollar India is trading weak this morning, weaker by 0.6%. So it did seem to have a little bit of reaction on those currencies.
There's a giant, not only trade narrative here, but a giant agricultural narrative as well. The number one export out of the United States is farming at the end of the day. Farming that's heavily subsidized by the U.S. government. And, by the way, that is a lot of the base that Donald Trump is speaking to. If you take away the soy, the corn, that a lot of the initial agreement between China and the U.S. that happened under his first administration, the farming deal that was never really followed through on, where do you get the alternatives? Brazil, India, a lot of these countries that are meeting on the sidelines.
And that's one trading relationship that certainly has strengthened since Trump 1.0, which is Brazil and China in terms of the soybean trade. And so China is much less reliant on those soybeans to feed its pig population on the US versus Brazil. It now has those supplies from Brazil. It's seasonal, so there is some gap there, but they have made that change.
And you mentioned the Saudi Arabia as well. There's also an oil story there because, again, one of the other major exports of the United States, oil. Where else do you get it? Iran, Saudi Arabia, etc. Lots to digest there. Coming up, we go right back to the number one conversation this week, which is, of course, the tariff story. With tariffs back on that list of worries for the markets, Bloomberg strategist Michael Masika argues a little caution may actually be a good thing for performance. Fascinating conversation ahead. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 49 minutes, we'll call it, into today's session. Green on the screen across the board, but not by a massive margin. The DAX is your outperformer this morning, higher by 0.4%. The FTSE 100 on the back foot, down about 0.1%. Not seeing a ton of volume or a ton of liquidity there, but Val, perhaps a lot of that just reflecting the oil drop that's getting magnified in the FTSE 100.
Well, look, if we look at the risk events for the week ahead, there really is not a lot of big economic data on the calendar. The one big thing on the calendar is the Trump tariff deadline coming on Wednesday. Today, we also have the second day of the BRICS Summit in Brazil. Tomorrow, the UK is going to be hosting Macron for a state visit. And the biggest economic data of the week is Thursday, U.S. jobless claims. So I think it kind of sums up how light we are on the data calendar. Friday, we also get Canada employment data to round out the week.
OK. Now, nations are scrambling to secure trade agreements, of course, with Washington or lobby for extra time ahead of Wednesday's deadline. President Trump says he will send out letters about tariff plans starting later today.
We're going to be very busy over the next 72 hours. President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2nd tariff level. So I think we're going to see a lot of deals very quickly.
US Treasury Secretary Scott Bessent, of course, over the weekend commenting on the timeframes and the moves to try and shore up some of these potential deals. For more on the market reaction to this, let's bring in Bloomberg's Michael Masiko. Michael, you've been writing about the fact that the move's a little lower on European stocks last week, so the end of the week lower, and that's no bad thing necessarily for these markets because these are markets now slightly more in balance, is the argument that you and the team are making.
Yes, it's a strange thing. You know, we had like a big increase in positioning on Europe, big expectation building in. Everyone kind of forgot about the tariffs. If you look at how investors were positioned ahead of today, it's strange. Like it's like this tariff deadline is a non-event. It's treated like a non-event. So either everyone has been hedging a lot and everyone is ready on their portfolios, or everyone is still underweight, which looks like it's the case. Like positioning is a bit like neutral at the minute, generally speaking. So it's like a wait-and-see situation. So we'll see the reaction. I mean, last time it was exactly the same on April 2nd, and we all know what happened. So we'll see. A bit of caution is not bad thing, indeed.
Is it caution or is it complacency? Is there a lazy trade in this market?
I wouldn't say it's complacency. There's a bit of complacency on the actual outcome, that we can say. But at the same time, if the positioning overall is neutral, if investors have been just chasing gains higher and are still not like overweight equity overall, which is the case in the US definitely, then it's not really complacent. It's more like it's still caution, yeah.
I thought maybe this morning equity markets would be higher on this new deadline of August 1st. I thought maybe we'd see a drop in things like euro-dollar 1 week implied volatility. Have we seen any action in terms of options pricing around European equities around the risk event of Wednesday? Or are we just not pricing that in at all?
No. We haven't been pricing anything. It's like I said, non-event at the minute. So either because people are like really well positioned already for this, or because, and I think that's what a lot of investors are thinking, it's like nothing is going to happen except either an extension or we'll get like, you know, some kind of deals with like, okay, partial deal, and then we discuss some other specific points. And that's what everything's thinking at the moment. Like no one wants to believe in a full-blown trade war because of what happened over the past few months. You know, it tells investors, okay, no one wants a full-blown trade war, so let's see what happens on Wednesday.
Michael, is the big, beautiful bill that was passed by President Trump on Friday, signed into law, is that a future catalyst, or is that fully priced in for these markets?
I think a lot of it is priced in, because if you see what happened on the MAX 7, what happened on the NASDAQ, how a lot of investors have been buying tech stocks like massively over the past few weeks, you can tell that fiscal spend is now getting properly priced in the markets. There's like, you know, we came into this year thinking the US is not the right place to be because of like Europe had a lot of fiscal spend, the US didn't, and then the Fed had higher rate than Europe. Now things are kind of switching. It's like investors are going back into tech because the US is going to spend. They don't care about the deficit. The Fed is looking like it's going to have opportunity to cut rates as well. And so,
but is that a NASDAQ story or is that a Russell 2000 story?
Well, at the moment, people just buy the tech. It will become a Russell 2000 story because obviously small caps will be the beneficiaries of a fiscal spend. But at the moment, this is not what's happening.
Well, it feels like the stock market and the currency market are dancing to two very different tunes. Is one affecting the other? Is dollar weakness incentivizing flows into the equity market?
So since the start of the year, we have seen a lot of that. Dollar weakness with euro strength was a very big positive for Europe. We had like a switch of assets from the US to Europe. But it kind of stalled at the minute. And now what we're seeing is it's very focused on the currency. So the dollar is still expected to go into bear markets this year for a lot of reasons, including the fiscal spending. But it seems the transition between the dollar weakness and what's happening to the equity market has kind of slowed down a little bit. So maybe we'll have that on emerging markets, especially because they're like the biggest beneficiary of a dollar weakness.
Michael, regarding these letters that the Trump administration is going to be sending out to trading partners this week, do you think there's a consensus within the market of the number that the EU is getting?
Well,
like would 20 be a shock? Would 30 be a shock? What's a shock number?
I think anything above 10 is a shock number because at the end of the day, that's what people have been expecting. Like, you know, we'll have 10% tariff and that's it. It's okay. People will live with it. But if we go back to what we had in April, everything will be a shock.
Yeah, it does sound like markets are complacent given Trump's latest threat on the EU was 50%. Well, yeah. They're expecting 10.
And there's the autos sectoral tariffs, there's the pharma tariffs, and the assumption is in these markets that we're going to get a baseline 10%. That does feel like that would be a very positive outcome.
Mm. Yes, it would be. I mean, if you look at especially for pharma, you look at the deal with Switzerland, pharma is likely to be included in that. If we have the same in Europe, well, you know, it's a positive for all the pharmaceuticals in Europe. I mean, it's like anything above 10 will be like a bit stretched. If we get 50, I mean, yeah, well, that's definitely not going to be taken positively by the market for sure.
It's a fascinating one. I think we had guests on the show last week saying that 10% is priced in, 20 is absolutely not. We'll see how that all shakes out. Bloomberg's Michael Masika walking us through the dynamics of these markets. We thank you so much. That does it for the opening trade. The Pulse is up next. Francine is speaking to Portugal's finance minister as the clock ticks, as we were just saying, for the EU to seal a trade deal with Washington. Throughout the morning, we've also heard from the Portuguese central bank governor as well, also talking about that risk, saying that there might be a correction when it comes to the euro. It'd be interesting to see what the Portuguese finance minister has to say on that, and maybe their defense plans, their spending ability. There's a lot to digest there. That conversation on the Pulse up next. As I said, that does it for the opening trade. These markets, seeing some green on the screen, light volume, light liquidity across the board, but your DAX is the outperformer this morning, higher by 0.3%. Stick with us. This is Bloomberg.